This is Radio Free Wall Street with Lee Adler, on the web at radiofreewallstreet.fm and wallstreetexaminer.com. It is 4:10 p.m. New York time on Wednesday, January 28th, 2015. I'm Lee Adler, and this is Radio Free Wall Street. Well, we had the FOMC statement today, and I'll go over that with you in a minute or two. I also want to take a look at the big LTRO refunding by the ECB that we talked about last week. I think that's a big deal. It's important. It sends a signal. Nobody's covering it, so hopefully it'll give us a leg up on understanding what's going on in the world. And we'll take a look at the technicals given today's sell-off in the New York stock market. First, let's look at the Fed statement. Well, very little has changed since the last statement, but I think there were a few things of note, and I'm looking at the Wall Street Journal's Fed statement tracker where they track the changes in the language in the Fed statement. And one of the new phrases that was inserted into this statement was this: recent declines in energy prices have boosted household purchasing power. Here we have the FOMC, the policymaking arm of the Central Bank of the United States of America, making the same mistake that the media and all the mainstream economists are making. And that is that the reduction in energy prices boosts household purchasing power. It does not in any way change household purchasing power. It merely shifts household purchasing from the energy sector to other sectors of the economy. So here again, the Fed, along with everybody else, is giving the misimpression that somehow the reduction in the price of gas at the pump is going to boost the U.S. economy. It's not going to do that. It's simply going to shift the spending that we normally do at the gas pump to spending at Walmart or Applebee's or Burger King or somewhere else. So therefore, it's not going to make any difference in that regard. Why the Fed is fostering this misimpression, I don't know. I'll leave that up to you to try to think about. I don't think it means anything other than the fact that we're operating in a fantasy world where people don't pay any attention to reality. In fact, my friend Alan Tonelson brought up today that there was some evidence that consumer spending is not keeping pace with the expected growth, and that there's an indication that U.S. consumers are, in fact, paying down credit card debt, which they would have an incentive to do so with the extra cash that they have, given the high credit card interest rates. So, again, the idea that the U.S. economy is going to be boosted by this is false. And the Fed is thinking that it's on track for being patient about raising rates, whatever that means. The consensus seems to be, everyone seems to think that it means June. Clearly is not going to be supported by soft growth in the U.S. economy that isn't going to pick up on the basis of any reduction in energy costs. So that's one misconception in the statement.